So today I'm going to be diving into permanent life insurance and how you can utilize the cash value as an asset. So I often get a question, how can I actually access the cash value in my policy? And this can oftentimes be a little bit confusing. So you may be searching for permanent policies because you want to start utilizing it as an asset. And you may talk with an advisor and you get shown this illustration with a bunch of different numbers on there. And it can be a little confusing as to what you can actually access and how you can actually access the cash value to utilize it for, whether it be income down the road, utilizing it for other non-traditional investments, so on and so forth. So I want to clear the air and talk about why people utilize permanent life insurance, different ways you can actually access your cash value, and a couple different creative things that I've done with some of the clients that I have and other people that I've seen out there and how they've utilized their policies. So just kind of starting out, why people utilize permanent life insurance as a asset is because of some of the benefits that you have with life insurance as opposed to other assets. So your cash value in your policy that you have, that grows in a tax advantage way. So you're not taxed on the growth that you have in your policy as the cash value continues to build. Unlike a bank account, for example, you get dividends on your bank account and you're going to be taxed every single year. You're not taxed on your life insurance cash value as that grows over time. Additionally, life insurance is also a protected asset as long as it's structured properly. So let's say, for example, God forbid something happens and you're now part of a litigation. As long as your life insurance policy is structured properly, they may be able to go after your personal assets. They may even be able to go after your business assets, but they can't go after your life insurance as long as it's structured properly because it's looked at as a protected asset. And then another reason why people utilize life insurance is because they don't have to go through a qualification process in order to access things like loans. So you may have equity in your house, but that's generally going to be quite illiquid, because you do have to go through a process of qualifying with a bank, showing your debt to income ratios, showing your assets versus your liabilities, all those different things to access, for example, your equity in a house. But with cash value in a life insurance policy, you don't have to go through all that. The asset is something that you own, so you would simply call your advisor or call the company, and you don't have to have a specific reason. You can just simply access that cash value without having to go through any type of qualification process or show your income, things like that. And additionally, another reason why people utilize life insurance is, particularly with whole life insurance, the cash value is not going to be market tied. So it's a very safe asset to utilize because it's not going to be tied to the market. So if the market has an impact and goes down, with whole life insurance cash value, that is not going to be impacted. And again, depending on the policy you have, you're going to have guarantees on that cash value, so there's no way that cash value can fall unless you take a loan or distributions out of your policy. So diving into how you can actually access the cash value in your policy. So there's a couple different ways. So the first way you can access cash in your policy is through a straight distribution. So with that, you are going to be taking, a distribution straight from your cash value, and that would decrease the amount of cash value you have and also your death benefit. With a distribution, you're taking the money out of your policy. So with that, when you do a distribution, any amount that's up to your cost basis is going to be received tax-free, but then any amount above that is going to be taxed because the IRS is going to look at that as you have made money, on an investment, and you're taking the gains from that investment essentially, and you're utilizing it. So it's going to be taxed as income. So how that looks, let's kind of break it down numbers wise. So let's say that you have $300,000 of cash value in your policy, and you take a distribution of $200,000. And your cost basis, what you've paid into the policy, is also $200,000. So all that money that you take out and utilize is all going to be tax-free because that's just a return of basis. But then every dollar you take out above $200,000, if you're doing a distribution, is going to be taxed as income because you weren't paying taxes the entire time that policy was growing. So that's important to know. The second typical way that people utilize their cash value in a policy is through policy loans. So policy loans are a great way to take money out of your policy. Loans are always going to be tax-free, but keep in mind that it is a loan. So a couple of different ways that people utilize policy loans is they can utilize them to, for example, create tax-free income for themselves in retirement. And if that policy is structured properly and the loans are also properly planned out, you may never have to pay taxes on any of that money that you take out, as long as that policy is still in force, when you pass away. Another way that people utilize policy loans is to essentially use that as leverage to make more money off of their non-traditional investments, essentially. So I have quite a few clients. For example, I had a client who had the option of taking a bank loan. That bank loan was going to be 8% in order to do a flip deal. And so I'm going to kind of make up the numbers because it's been a while since he did that distribution. But let's say that house flip he was going to get a rate of return of 20% by doing that house flip. So he puts in $100,000, gets a rate of return of 20% over a year. So he ends up with $120,000 after, that year. Well, if he had taken that bank loan would have been 8% charged on that money that he got the loan with. So his net rate of return would have been 12%, because you have 20% from that house flip and then 8% from that loan that he took out from the bank. So instead of doing that, we took a loan from his policy cash value. So with that, the loan rate on the cash value was about 8%, but that policy was appreciating at 6%. So the net loan cost was 2%, because he's not taking money out of the policy, he's simply just taking a loan from the policy, and that policy is still growing. So the net loan cost was 2%, and then he puts that into his deal, getting 20%. So instead of taking a loan from the bank and getting 12% on his entire deal, he took a loan from his policy and got 18%. So it's a great way to essentially utilize an asset that is also growing to get a better rate of return on deals and business transactions that you're doing as well too. So that's just one of the creative ways you can utilize loans in your policy. The third way of utilizing money in your policy is actually by taking what's called an I block, or an insurance-backed line of credit. So when you do that, it's actually going to be very similar to the process of a HELOC or any other loan that you'd get through a bank, except that as opposed to like just a regular loan that you'd get from a bank, this loan is going to be secured by the cash value in your policy. So not every single bank does this. There are special banks that will issue I blocks. So you'd have to go to one of these, particular banks. But for example, you take out $100,000 in the form of an I block, and that is a loan again through the bank. So they're typically going to give you, what prime rate is plus 0.5 to 2%, typically, depending on how much you actually take out in the form of that loan. So let's say the prime rate is currently 4%. That means that your loan may be 4.5 to 6%, just based off how much you've taken out and also the terms of that bank and current prime rates as well too. So in almost all cases, that secured loan, since it is secured by your cash value, is going to be a better rate than an unsecured loan that you just get from the bank without having to put down collateral. And that's simply just because the bank sees it as, hey, this is safer for us because you're giving us a way to essentially hedge our bets by using that collateral from the life insurance policy. So those secured loans are, again, in almost all cases, going to be at better rates than unsecured loans. Another way that you can utilize cash value in your policy is through using the dividends. So if you have a policy that does participate in dividends, these are typically going to be whole life policies, and you want to make sure it's with a great company, of course. You can actually utilize simply the dividends, not having to access your cash value in a policy. So I had a client, and based off how we structured their policy, they were going to only fund it for the next 20 years. And then after those 20 years, about another 10 years later, they're going to be about 65 at that time, and so that's when they want to retire. So based off the policy that we had structured, just the dividends in the policy without having to actually touch the cash value, and those are dividends that companies paying back to that policyholder, they're going to be able to take $20,000 of income at age 65, for the rest of their life without having to touch the cash value in the policy. Now they can increase their income if they want to touch the cash value, but this is just straight coming from the dividends. So those are different ways that you can access cash value in a policy. And then another way that you can actually utilize cash value in a life insurance policy is by doing a 1035 exchange. So let's say, for example, you get a whole life insurance policy because at a very young age, and just based off how life goes for you, you get to age 60, 65, you're in your time for retirement at this point, and you don't have really any need for that life insurance benefit, that death benefit, because you may not have anyone that you need to pass that money off to, in that case. So not all is lost at that point. You can actually utilize the cash value in your policy and do what's called a 1035 tax-free exchange into an annuity, and that annuity can provide guaranteed income for the rest of your life. So I talked a little bit about annuities during our last video, so feel free to check that out if you want to understand more about annuities. But that is just another way that you can utilize cash value in a life insurance policy. So I hope this video was helpful and hopefully cleared the air as to different ways that you can utilize cash value in a policy. And if you guys have any questions, feel free to comment, reach out, and also share this video if it was helpful. And yeah, if anything comes up, just feel free to reach out. We're happy to answer any questions and help you guys really make sure that you are building out something and structuring any type of assets that you feel like fit in your wealth building picture in the proper way to hit your goals down the road. And we'll see you guys soon.